Hello and good afternoon. Thanks for joining today's Market Color webinar. Before Jordi shares his thoughts, we would like to share our compliance department's thoughts, which are as follows. Weiss does not recommend particular stocks, bonds, options, derivatives, or securities of any kind. We do not guarantee any results or investment returns based on the information that you receive. Although we have used our best efforts to provide the most innovative trading and investment strategies, the views presented today are forward-looking statements which are subject to change as circumstances change, and we cannot promise future profitability. If you have any questions or follow-up after listening to this webinar, please feel free to reach out to Jordi and/or the marketing team. Weiss would love to hear from you. A replay of this webinar will also be available on the Weiss website and YouTube channel later today. And with that, Jordi, the floor is yours.
All right. Make sure. Hi, everyone. Just wanted to give an update on things. One note, since I'm getting a lot of requests this week, the Kentucky Derby piece will go out tomorrow. So today I just wanted to update where things are on the market, because I think we've hit the next point of movement and importance. On the last one, I talked a lot about where we are over the next 3 months, and using the same analogy, there's going to be a lot of body blows coming forward as the data just continues to pressure the Fed on where their stance is. And I just wanted to kind of discuss the most important point that I keep hearing, where I think everyone has to make a decision on this concept of transitory. The majority of people seem to believe that whatever is coming is going to be transitory, and that, as is always the case, technological innovation will allow for the supply side to catch up to the demand side. I do not think that that is people should be complacent about that. As someone who has obviously for years written about and focused on innovation, this is a new situation that has structural components behind it that I think people are underestimating in terms of shoving money into the system, the China-US divorce, the climate change move, and the impact from COVID, which I think is going to last. So the real question for everyone here is how they define transitory. So what I want to do is just kind of talk through transitory. I think the number one most important gauge going forward is going to be the ISM, and especially the internals. I'll take you through that. And then at the very end, I do think there's a couple of lagging areas where you're going to start to see some catch up as we hit the next phase of what I'll call the inflation bet. Most people think tips and various parts of the market have already discounted things. They expect a rate of growth or rate of rise on the ISM to flatten out, which seems fairly obvious. So I just want to take you through where I think there's a difference in these viewpoints. So I'm going to start with the ISM here. Obviously, the most recent reading put us at the highest level since 1983. So on the just 1 month basis, you're already sitting up at these incredibly high levels. As you go through this, and you think about the leading indicators that I've shown repeatedly, this just has the new orders component, which is the orange line. The white line is global stock revisions. Neither of those have shown any signs. So I don't think at this point people should be expecting the ISM to come back down. I think we're going to continually have prints up here until we start to see some of the leading indicators. And those are just two of some places where I've gone. And obviously you have 10-year yields here. And what you have seen is that after breaking through a big resistance area, which was really in this 140 to 150 area, all we've really done is consolidate up here. I think the majority of people were short bonds at this point, knowing that growth was coming. That looks like a consolidation of something to go higher. And I think as I go through this, I do expect 10-year yields to get at least above 2%, and I would say more towards 3% before the end of the year as this pressure continues on the stuff that I'm about to show. This is where I really think people are going to have to start to focus, is on the moving average. This is the 5-month average of the ISM, and that's really where it comes into. My whole thought process on approaching markets and looking for surprises starts with the ISM, and really what I'm trying to do is think about where it'll be 6 months from now. If you believe that the PMI is going to come out down in the 50s. If we're at 57 come November, then I think you want to be betting that rates are at best going to sit around here and that most of the cyclicals versus defense trade is done. If you think the ISM is still going to be above 60 in 6 months, meaning we're going to print another 5-6 months of above 60 numbers, then you're going to move this average up even higher. And just to give you an idea, on a 10-month basis, you'd be putting yourself at highest level since the 70s. So one of the key things right now in differentiation is I don't think it's about where the whether the ISM is higher or lower than it is now. I think 6 months from now, you need to make a decision on whether it's above 60. The way that I'm thinking about this is all related to supply and demand. I do not think we are going to be able to catch up to demand, which only now is accelerating. So this ISM number is not related to a massive drive in demand. We're still giving out money as we speak, as I'll show, and those numbers and the reopenings are still going on, not just in the US, but around the globe. This is the back orders. The white line is the backlog of orders. That's at a high, and again, these things are accelerating. So as we're starting the reopening, you're getting more and more demand. You can see it across in everything. Everyone has seen incidences across the country of shortages, and I just don't see where the order backlog is going to be able to catch up, because I think it is the supply side that for the first time during at least my career is having troubles catching up for a variety of reasons, which I'm happy to speak about offline with people, but I think that's where the change is. This one is that backlog order, and this is now less customer inventory. So you've got a tremendous amount of orders, and clearly you don't have the inventory to match up, so that we only have data going back to 97 on this, but we're well above the prior peaks. I think you're gonna need to see some normalization in that before you have any indication that the PMIs have reached their peak. Again, I showed this last year. This is going back to 1979. This is supplier delivery times. So it's not just the orders, it's the fact that when you're ordering stuff, it's taking a long time to get it. Anyone who's tried to purchase a car in the last 3 months, the delays just continue, and we've seen the semiconductor shortages that have been announced. I don't see any of that changing for at least the next 6 to 9 months. And the question is, if it takes more than the 12 months, how much of that is really discounted in the market? This is the monthly SARS auto number. So you have the orange line here, which is the demand side, and then you have the inventory, the car inventory numbers. So we're at basically 20-year lows in inventories at the same time that demand is accelerating. And if you look back at the great financial crisis, what you'll see is that the demand coming back took a long time. It was definitely not something which was a spike. And in this case, we're already back to where we were before the pandemic, and now we're getting above where we were even 3 years ago. So I think this situation is far worse than people seem to believe. And autos are obviously very important. Just another indicator that I think suggests the same thing. We continue to see used car prices go higher. This is the 12-month rate of change of used car prices. So far this year, they're already up about 20% just in the year to date. So you're continually seeing it. This is not just a COVID bounce. This is a continuation. You've heard about shortages in used cars. In car rental or rental cars. So you're continuing to have a situation where we've got pent up orders and we just don't have enough supply to meet them. Finally, this is for the housing market. This is the new house supply. We just don't have houses, and we're near lows on that, and everyone has seen how strong the housing market has been, and I think that's going to continue because rates are stuck at low levels. The Fed's telling everyone it's going to stay there, and we continually see the move outside of the cities for a variety of different reasons, and I continue to believe that that is a trend that people are underestimating as millennials finally enter the housing market and need cars as they're moving out of the city. All of that led, obviously, in the first quarter, and this is one of the reasons why I think the rates market was in a consolidation. This is the Barclays Ag quarterly return. So you can see the white line is we were down 3.37% in the first quarter. That was the worst quarterly performance for bonds since 1981. So I do not think it should be a surprise that rates are going sideways. The interesting commentary about 1981 for people interested in history. That is the year, and that is just after Paul Volcker raised rates to 20%, really taking it to the highest level and saying that we were going to beat inflation. Now we have a central bank that is saying they want inflation, they're trying to drive inflation. I think everyone should not be getting complacent with the transitory side when you have not only the situations that I mentioned, but you have a Fed that is saying they want inflation, and you have a redistribution plan going at the government level, which is printing money and giving it. And I think this is just, we're underestimating the structural shift that's happening and how quickly it's happening. And it comes at a time where I just don't think the supply side is ready. Now, to show how important the ISM is for the equity markets, I'm just going to roll through these. We've seen, this is versus quality. Obviously, inverted quality has been getting hit. You've had junk going higher versus quality, but since rates kind of consolidated, you can see that we've seen a move lower while the PMIs are still up here. As long as the PMIs are up here, I believe you're going to have a hard time having quality really start to work. It's just difficult because of the low beta nature. At the same time, this is size inverted, so you've had small cap outperform large cap. And recently you've seen a pullback. I would expect that pressure will continue. We'll start to see small caps outperform again in the next leg higher in rates. And this is beta versus the ISM. So, same type of story. It just shows you the impact that PMIs have on all assets. And here's rates, and I've shown this chart before, but just to make sure, each of these lines is the cyclical peak in PMIs during various times, and the white line there is 10-year rate. So when we do peak in PMIs, you typically get rates to stop moving up. Now, the one thing I will identify is in here, you still had them sitting up at higher levels when we cut taxes, and rates continued to kind of migrate a little bit higher. And here are rates right now. So I do think you're going to start to get up into this 2.5 area based on what I'm going to go through on the rest of the charts, because I think people are, again, not looking through the pressure that's continuing. So PMIs matter a lot. This is the inventories versus backlog, the white line again up at the highs. And now we're starting to transition into commodities and how important all of these PMIs are to commodities. So this is the CRB raw industrials index. It just broke through after a consolidation as rates went higher. So now we're starting to see commodities move higher. And I'm going to just show you each of the commodities charts. This is it on by itself. So again, you're getting an acceleration again, moving higher. But it's not just raw industrials, and I think what's changed the most since the last webinar is just the acceleration we are seeing across commodities. You've obviously seen it in lumber prices. Here's food, and as I'm teaching my son about pattern recognition skills, this is going more parabolic. This is actually accelerating at this point. So you've got food moving up to the highest level since 2011. At the same time, this is livestock prices, which are moving in the same direction. And when you take all of the commodities together, the precious metals, the industrials, the food, the livestock, you're getting a fairly unprecedented move in commodity prices going back a long way. So this is all commodities for spot commodities. And you can see the extent of the move, and again, the acceleration. This is it on a long-term scale. So this is back to 1984. We're at 53% year over year. So we're above any other time in the last 37 years. And again, think about it. I showed you the bond returns. I showed you the PMIs at these levels. We have commodities continuing to accelerate. This is the year-over-year CPI. So again, we know this is going higher. The question is, at what level are we going to get to? And I would expect that when we are done at a peak, we will be somewhere near 5.5 to 6 based on everything that's going on. So I think people are underestimating what's going to happen over the course of the next 4 months. And it's easy to say things are transitory now. I think it'll be harder. One of the other dynamics that I think people have to really build into their mindset is what happened really in 2010. So commodity prices, which are again the white line here, they peaked in here. Now, this orange line here is fixed asset investment year over year in China for real estate. It peaked at 40% and it went down, and you can see that it dragged commodity prices. We bottomed around zero, and then when China started to kind of, let's say, not be in that position, they let the housing market go again. You started to see an increase in commodities post the energy fall, and then we had the trade war come in. So commodities were already starting to move because China had settled in a growth rate of 7 to 10%. The reason that's important is back here, the size of China's GDP was about $6 trillion. It is now $15 trillion. The most similar period I've seen in commodities in terms of the demand side versus supply side was really in the 2002 to 2007 period, which was when China had this big growth situation helping to drive it. Well, we now have a global climate change infrastructure demand. We have the US accelerating and moving more into a housing market and needing autos, and we have China now back in the 20 to 30% fixed asset investment real estate growth side. Back in 2002 to 2007, China's GDP was about $1.5 trillion. So you're talking about a GDP which is now 10 times what it was back then. So I think people, again, are not paying attention to the math associated with the demand side that is coming from both the US and China in a very, very large manner, driven by the amount of money we've put in at the same time that the Fed refuses to raise rates and says it's not going to happen until we get into 2023 and 24. The laggard behind this, and where I think you're going to start to see the pressure, as is always the case, I've talked a lot about crude, as if you're going to keep rates too low and you're going to say that you're going to keep rates at zero for the next 3 years, then I expect crude prices to go up significantly as the reopenings occur. Here is that total commodities index all over, and this is 12-month crude prices. So I fully expect that we're going to see crude play catch up here, mainly because I think we're about to get the reopening. The demand side is going to happen. You're hearing about issues that will probably happen in the US in terms of gas. This is another thing that shows that the market is actually believing it's transitory. So this is a consensus view, in my opinion. This is the energy service sector relative to the S&P, which is down here. And this, the other line is 12-month crude prices. So crude has gone up, and you still have people being willing to go buy technology, safe quality names, things along those lines. I think the energy sector, which we've talked about, has a very small market cap. As people become more convinced that crude is in a structural bull market for now, and I do suspect there's a risk here that people are underestimating, that we get into the 80 to 100 range in crude prices before the end of the year. If that were to occur, there's a lot of implications that come in, and that whole transitory argument would not only go out the window, but you'd be playing catch up to where inflation would be at that point. This is the full energy sector. So that was the service. You're not getting any difference here. So this has got exploration and everything else built in it. But you right now still have an undervalued energy price, which is betting in that this is transitory. This is gas at the pump in the US relative to two-year break-evens. You can see that two-year break-evens today are breaking out. Gas prices are will follow what crude does. So if crude goes up and you get up into the 80 to 100 range, which would mean another 30 to 50, 60% rise, you're going to see a similar move in gas at the pump, and that would have huge implications for the CPI. It would also have huge implications for the bond market and put more pressure on the Fed. So I think gas and crude is an important part. And with that move in two-year tips and break-evens, here's where we are now in terms of real two-year yields. We're almost back at the easiest we've been. This is the dollar against it, so I fully expect the dollar will continue to move lower following real two-year yields. I've talked about the fact that I think that the rest of this year is about inflation. It's not about growth, and it's about central banks and how they're attacking inflation, and from a government side. So with the US both printing more money, handing it out at the same time that the central bank wants inflation, they're basically debasing the currency, and I fully expect the dollar will not be moving on growth moves. It will be moving on real two-year yields. Moving to kind of the final part of this in terms of going through it, I'm getting back into the fact that, let me just make sure, this is PMIs again, and this is just the pressure they're pulling with 10-year yields. And again, real 10-year yields, which people were forecasting would be moving up to zero, With this consolidation in rates, all that's happened is we've moved real 10-year yields back down to where we were in February before we saw the rate rise. So we're back down to here while rates went higher. And again, that just means inflation is keeping the pressure on, and people do not believe that it's going higher. So I still believe that you need to be focused on the inflation side. This is just showing it again in separate form. So this is tips, 10-year tips, making a new high today at the same time that rates have consolidated. So that pressure from the inflation side expectations will continue. And remember, tips are going to trade off energy and they're going to trade off gas. Pure growth versus pure value, you've seen a pullback in this. So you're starting to, as usual, as Paul Tudor Jones says, price moves first, narrative moves second. Now everyone's starting to get excited again about growth because you had this big move with value over growth. Now what you're seeing is you're seeing a pullback in value versus growth, but you're starting to get to move higher in yields. This is just showing that it's been a yield view. So when people say transitory, I think everyone in the marketplace is in that same camp. This is an important one that I've shown before. This is personal income. Now, this is the survey, just to give you an idea. This will be released next or later this week. We're expecting the highest print on record in terms of income growth month over month, even bigger than the ones that we saw during the COVID period. So from an estimates basis, I think people again are underestimating that the flood of money just came in April. So you're going to still see data. This is where I talk about the ideas that I think people should be focused on that are lagging. So my favorite idea for the rest of the year is in emerging markets. And obviously it's getting a tremendous amount of bad press. They're having trouble fighting COVID in all countries, but as we learned last year, when the US was in the worst of COVID, the market went straight up. So the real question is, what's going to be the benefit? And the reality is, at the end of the day, they're already lagging. Emerging markets are dependent on, or have been historically, on commodity prices going higher. And although that's not the direct relationship anymore, it still does matter for a lot of different reasons when commodities are going higher. So this is the JP Morgan Emerging Market FX. And this is the commodity side. So everything was correlated, and then all of a sudden you got this move back up here. I'm going to show you that a lot of this has to do with COVID, and a lot of it in particular has to do with a country I lived in, Brazil, which I still believe has a huge move left in the year. This is it, the currency relative, or the currency index for EM relative to cyclicals versus defense. So clearly has lag. And then as I start to transition, I want to bring up Brazil. So in terms of COVID, one of the reasons that I think it's time to be focused on what's happening in emerging markets is this is the 7-day rate of change in COVID cases in Brazil. So even though they're behind the curve and they're getting a lot of negative press, what you're seeing here is that their cases are dropping significantly on a rate of change basis. And so what we're starting to see is a movement. The Brazilian real today broke through the 200-day moving average. It's been above it. It had broken below, we had a stronger Brazilian real coming out of the election, as you'd expect, but then starting in December, it started to weaken again as COVID cases were running out. So the fact that COVID cases has come down should be a trigger point. And here's the Brazilian real relative to commodities. So it's Brazil, more than any country, is directly related to commodities, all of them. And so as I go through this, just remember the Brazilian real in particular is the most attractive asset in my point. I think it's undervalued significantly on everything that I could use. I'll just take you through a few charts. This is EWZ relative to the S&P. So this is the Brazil ETF versus the commodity. So I fully expect EWZ to go up significantly over the rest of the year. I thought it would be the best trade for this year. COVID slowed it. I still believe it's going to have a breakout performance, but it needs the currency to move. So again, this was the ISM at the beginning. So what I'm going to just show you is a couple more things on Brazil just to end it. This is year over year real, which is blue, and this is it year over year food prices. Brazil's obviously a major provider of global food, so it's already lagged behind that. This is the Brazilian real relative to livestock, obviously country filled with meat. You've got another lagging on that side. This is the Brazilian real relative to raw industrial materials. They do have a lot on the iron ore side and a lot of industrial metals, so you still have that. This is it relative to sovereign spreads for Brazil. So this is the MB sovereign spread. So again, the bond market in Brazil is much stronger than the currency at this point. And then finally, this is the Bovespa, the equity market, also up significantly relative to the real. So all of these pressure points, along with the next stage of the inflation and the improving situation expectations on COVID, it's just a relative value trade that, to me, when you're looking for inflationary points, you have the energy sector in the US, you have Brazil and emerging markets, and those are some of the laggard places that I'd be looking for as people start to leave the transitory world and start to think that this could last longer. And that's what I think you're going to start to have building into the market over the next 2 months. That's it for me today. Again, you'll see a Kentucky Derby paper from me tomorrow. Otherwise, I'll be back hopefully in a couple weeks.
Thanks for joining today's webinar. Have a great day.